Hey everyone, Paul Stafford here with Elite Wealth and Wellness. Welcome to our second video in our 4-video series of stock market realities. In the first video, we talked about the fees and taxes and how those were eroding your profits. In this video, we're going to introduce the hidden fees that you're paying on your retirement plans and managed mutual funds that don't show up on your prospectus. Again, in the last video, we went over an example given by the late John Bogle, which showed that if you have 45 years of time to put money into the stock market at an average 8% return, and your fees were 2.5%, that you would earn $8, that Wall Street would earn $21, and the government would earn $3. So again, as I talked about in the first video, when you look at your prospectus, you're only going to see a 0.8 or 0.9% expense ratio, but there are several hidden fees that you haven't accounted for. So although your mutual fund and retirement plan funds may be earning that market average 8%, you are not earning that 8%. So how much do you think you might be losing, and how is that affecting your nest egg? Do you have any idea what your fees are in the accounts you hold? I certainly didn't. I didn't even look at it until I became aware of this potential, this giant effect that these fees are having on my own account. So ask yourself, and then you'll take a look. What do you think you are paying on your retirement funds and your managed mutual funds? Is it 0.9%? Is it 2.5% that Bogle talked about, and we went over that in video 1, or is it even higher? And I would suggest to you that it's probably even higher. So again, the late John Bogle went over this in several different examples, but a very simple example that I like to remember is what I call the 10-30 rule. And he talked about this a lot about how much these fees are eroding your profit. So he gave another simple example that said, if you put $1 into the market and leave it there for 50 years, and say the market is earning an average 7% return, if you put that into a compounding calculator, you'll see that 7% over 50 years with $1 of initial investment, you'll have $30 at the end of that 50 years. However, if you take 2% out each year for your fees, and you're only earning 5%, then at the end of that 50 years, you'll only have $10. So again, you can pull up any compounding interest calculator and confirm this. If you put in 7% interest rate for 50 years, that you'll get about $30 here. So it's actually 29, but we're going to round to about $30. But if you take out the 2% fees and you put in a 5% compounded annual return, you'll see that the end capital is $11, but I'm going to round that to 10 for simplicity. So we're talking about $30 here and $10 here. So that's why I call this the 10-30 rule. So again, you're only earning $10, but you should have earned $30. So again, where did that $20 go? Well, if you looked at and watched our first video, you know where that money went. That extra $20 that you didn't get goes to Wall Street. So again, if you put that in and you take out the 2% fee, take your part, which would be 5%, that total earnings, the remainder of it goes to Wall Street. So again, we used, in our first video series, we used 2.5%, and this 10-30 rule that I like to call it, we use 2%, but you can see either way, you're losing a tremendous amount of money to Wall Street fees. Now, again, you'll probably go look at your own prospectus in your own account, and you'll see this expense ratio of 0.8 or 0.9%, which is pretty typical. However, that's not all you're paying. But we use 2.5%, and I would suggest, again, that's probably too low, because an expense ratio you see on your prospectus is only one of the fees. Now, the expense ratio is accounting for marketing costs and management fees, and that's all it's covering. But there are at least 4 other hidden fees that are significantly affecting your profits. And I've put these in order: transaction cost, advisory fees, cash drag, and taxes. I'm going to go through each one of those and explain to you where these fees are coming from. So the first hidden fee are transaction costs. Now, if you have a managed mutual fund or a retirement plan that holds managed mutual fund, which almost everyone does, the transaction cost is basically the brokerage fee. So inside these managed mutual funds that you hold, the managers are buying and selling stocks all the time, trying to get a better return. So each time they buy or they sell these stocks, there are brokerage fees and brokerage commissions that come with that, and those are passed along to you. Now, this study out of 2007, talking about the role of trading cost, estimated that those transaction costs are on average about 1.4% per year. So the next one is the advisory fees, and this is usually around 1%. The advisory fees are what you're paying your fund manager if you're in a retirement plan through your employer, or if you have an independent financial advisor that's helping you put money into these managed mutual funds. You're probably going to pay them about 1%. Now that may vary slightly, but on average, I found that to be pretty typical. And my 401k plan advisory fees, when I called and talked to them about it, are indeed 1%. So that again is added to that expense ratio. It's added to the transaction cost to increase your total fees you're paying. The next one is this concept called cash drag. Now, cash drag is due to the effect when you put your $100 into the mutual fund managers don't put that entire $100 into the market. They have to hold some of this money back for liquidity needs. When they have people buying and selling and entering and exiting the mutual fund, they have to have some liquidity. So if you put $100 in, you're going to pay that expense ratio on that entire $100, but they aren't putting the entire $100 into the market. So the effect of that is that you're going to have an additional fee or decrease in your revenues from that. And the study by O'Reilly in 2011 estimated that the cash drag on average again, this is averaged over many different managed mutual funds, is about 0.8%. So you're going to add that in to what you're paying in fees. The next one is the taxes you're going to pay, and that's been estimated from Morningstar to be about 1%. Now, let me be clear, this is not the taxes you're going to pay when you pull that money out of the market. These taxes are internal to your mutual funds. So if you have a single stock, if you own a single stock, the way you're going to have to pay tax on that is if that stock gives you a dividend, you're going to pay a tax on that. Or if you sell the stock for a profit or a capital gain, you're going to pay a tax on that. That's what I call an external tax. That's when you get a profit or you take a dividend, you're going to pay tax to the government. But the taxes I'm talking about in the hidden fees are an internal tax. So mutual fund holders that are in managed mutual funds are going to pay a tax just by holding this fund. Even if you don't take any money out of it, you're going to suffer from these internal taxes. Now, how that happens is if you have a stock, or if that mutual fund you're holding has a stock inside of it that does pay a dividend, the mutual fund is just going to take that dividend and reinvest it, and you're never going to see it. However, the government is going to charge the fund a tax on that dividend. So you're going to have to subsidize that. The other way you might be paying taxes are if some of your mutual funds hold bonds in them. If you're having bond interest, that's going to get taxed, and that's going to be passed along to you. And the third way that you may have an internal tax is if the fund manager sells a current stock in your mutual fund at a profit for a capital gains, there's going to be a tax incurred on that. And when you add all these things up, these internal taxes can go up to about 1%. And again, that's added to all these other hidden fees. So when you add all these up with the expense ratio that you see on your pro forma, the transaction cost, the advisory fees, the cash drag, and the internal taxes, the fees can be as high as 5%. So you can see now why I say Bogle's example of 2.5% is probably too low. So how might you be able to decrease these fees and so you can increase your profit? Well, one way is to not be paying an advisory fee. So if you have an investment advisor, you're going to pay that 1%. So if you invested outside of an advisor and did this on your own, you can decrease that fee of 1%. Also, if you're in a 401k or other managed retirement plan through your employer, your fund manager is probably charging this. So if you're in a 401k, or similar vehicle through your employer, you probably can't get out of this advisory fee because you're going to have to do this through a fund manager. So how about transaction costs? There are ways to lower your transaction costs, and one of the ways is to buy index mutual funds rather than managed mutual funds. So what is a index fund? An index fund is a type of mutual fund with a portfolio constructed to match or track the components of a financial market, such as the S&P 500. So the S&P 500 is composed of 500 big companies. If you're in an index fund, the mutual fund is going to hold stocks that are on the S&P 500 list, and they're not going to be bought and sold along the way. These stocks that you're going to hold in this index fund are going to stay fixed. So because they're not being sold and other mutual funds bought along the way, you're not going to incur those transaction costs, which are the brokerage fees when they're buying and selling funds. So if you could take out the advisory fees and these transaction costs, you could get your fees down to that 2.6%, which would be more in line with what Bogle's example showed us. What about the internal taxes? Well, if you are in a 401k or other pre-tax retirement plan that's tax deferred, you will not incur these internal tax fees. You'll lose that 1% because inside of a 401k, any gains, whether they're dividend gains that are reinvested, whether they're capital gains through the selling of stocks with inside your mutual fund, you are not going to pay taxes on those. But I would ask you, is saving that 1% really worth it? Because if you are in a 401k or other pre-tax qualified retirement plan, to get rid of that, to save that 1%, you're going to have to pay these other fees, such as transaction costs, advisory fees to a fund manager, and you're going to have this cash drag. So I don't know if it's really worth it to save that 1% to pick up these other fees. So in summary, the majority are completely unaware of the fees. I was completely unaware, had no idea. And most Americans, frankly, just don't have any idea what they're paying in fees. So when they get to that retirement finish line, they look at their $10 of nest egg. If they put in $1 and they have $10 at the end, they're celebrating that $10. But now I understand that it should have been $30. So we want you to be a $30 investor, not a $10 investor. And the only way you can do that is by becoming aware of these fees and then starting an investment strategy that will help you decrease these fees. And importantly, again, when you hear that average 8% market return, that might actually be true for the market, but it's not what you're earning on your investments. So I always say the first step is awareness. You have to realize this is going on before you get motivated to do anything else about it. So again, how can you lower your fees if you do want to change something? Well, one way is if you're going to invest in mutual funds, consider index mutual funds where you'll lower that or eliminate that transaction fee. And also, if you're doing this on your own, you can eliminate that financial advisor fee. Also, if you own single stocks, you're going to not have many of these mutual fund and managed fund investment fees. However, if you're investing in single stocks, because it's only one stock, you have to be more educated, and there's certainly more risk if that one stock goes down. The other way, again, as we talked about, tax deferred plans do keep you from paying that internal tax, but it comes at the cost of the rest of the fees. And the other way you might consider lowering fees is considering investing outside of this accumulation model and instead investing in cash flowing assets, which can lower all these fees and increase your return. So to summarize and sum up today, the expense ratio you see on your pro forma is only one of the fees. And no matter how hard you look in that prospectus, you're not going to see the additional fees because they're hidden. Actual fees can be as high as 4 to 5%. Bogle estimated 2.5%. They're probably somewhere between there for you. But again, even at 2.5 or 2%, it's still a significant reduction in your profits over your years. Most never realize that they are $10 investors because these fees are hidden and you only see what your account is worth. You can't see what it should have been worth. And finally, how do you become a $30 investor instead of a $10 investor? Well, index mutual funds are one way. Tax deferred accounts can lower part of those fees. But another way is thinking about alternative investments that are outside the market that cash flow, because you're not going to have these fees in cash flowing assets. So I hope this video helped you understand that there are truly hidden fees eroding your profits on your mutual funds and your retirement plan accounts. And that first step is always awareness. The second step is changing your actions and changing how you're investing. I hope you'll join us for our third video, which will go over how the market volatility affects your profits, even if you're not taking money out. Until that time, change your mindset, change your actions, and that can change your life.